Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, the beauty of mathematics, part 42. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below or the pinned comment. We're going to go through a few charts in this video. We'll of course touch base on the normal ones that we look at in this video series, but I will also talk about a few others. It is the first of the month, but it is also the first day of the year of 2024, and so it might be nice to just take a look at some other charts within this video to get a better grasp on where we potentially are within the current market cycle. So every month, on the first of the month, generally speaking, I try to make a video where we take a step back from the short-term price action and look more so at longer-term trends to better understand periods of undervaluation and overvaluation. That is the general purpose of the Beauty of Mathematics series. And as you can see, the blue line here is the actual total market cap of the entire asset class. And we go through periods of overvaluation and undervaluation. And oftentimes when we are overvalued, we can be overvalued for a year or more. And when we're undervalued, we can be undervalued for a year or more. You can see that we first entered into the undervaluation territory in June of 2022. So it's been about a year and a half. Now, as of January 1st, 2024, the total market cap of the entire asset class is coming in at a modest 1.695 trillion, with a fair value logarithmic regression trend line at 2.249 trillion. This represents an undervaluation of approximately 24.65%. Now, the general idea that we've discussed is that as the market goes from being undervalued to being overvalued, there can be rotations of capital. And one of the things that we mentioned going into 2023 is that the Bitcoin dominance will likely go up for the entire year as capital rotates from the altcoin market to Bitcoin. In overvaluation territory, what often happens is the Bitcoin dominance can start to come back down especially after that initial move. But we're still well in the undervaluation territory right now. We can overlay the risk metric onto this chart. This is the total summary risk metric that takes into account not only the price risk, but also the on-chain risk and the social risk. And when you combine all of those and you color code the current price action by that risk metric, you get a chart that looks like this. And so you can see that we've been at relatively low risk levels back in late 2022. Ever since then, the risk level has been a little bit higher, and recently the total risk has actually been trending up quite a bit, given the on-chain risk has gone up so much, and of course the price risk as well. But with transaction fees soaring, the on-chain risk has gone up a considerable amount. One exercise that we can do is take the percent difference between the total market cap of the entire asset class and the fair value logarithmic regression trend line, which, as we've said before, is a monotonically increasing function. The reason it's monotonic is because we assume that adoption is always taking place, even though the current valuation of the market cap of the asset classes does not always reflect that, because we go through periods of greed and fear. And so it's important to remember that if you're an investor within the Cryptoverse. If you take a look at the percent difference, that you get a chart that looks like this. So you can see that we've gone down to about 50, maybe a little less. I mean, about 50% undervalued or so. Last cycle, if I just sort of draw the line across, last cycle during the pandemic drop, we went a little bit lower. The cycle before that, we were a little bit lower. You can also see the highs from this last cycle were somewhat tempered compared to the prior highs, even if you account for diminishing returns. So the general idea, and I've said this before, and this was a prediction that I made in early 2023, was that for the entire year, we will spend the entire year below the fair value logarithmic regression trend line, the red line, but above the lower green regression trend line. So despite all the price action, all the ups and the downs, mostly ups, honestly, in 2023, the total market cap still remains below the fair value and above the lower regression trend line. The lower regression trend line right now, by the way, is just south of 750 billion or so, approximately 750 billion. You can see previously when the total market cap was dropping back in late 2022, it went down to about 800 billion. So the lower regression band right now is actually still lower than where total market cap was in late 2022. But by the time we reach approximately halfway through the year, the lower regression band will have met where we previously were in late 2022 in terms of where that lower regression band is. So that's an important distinction to remember. Now, oftentimes, I don't go too much further in to these discussions within this video because I like to keep them somewhat succinct. But this is also the first video of the year of 2024. I do want to show a couple of other charts just to get us all thinking about where we are within the current market cycle. I think there's two valid arguments to be made as to where we are within the market cycle, and I would like to present both of them to you. If you've watched this channel, you should not be surprised by either of these two presentations, but if you're new, it might be useful to view the market in both of these ways so that we're not potentially caught off guard. The first way is the more bullish way. The second way is the more bearish way. The more bullish way just looks at ROI from cycle lows. If you were to look at the ROI of Bitcoin from bear market year lows from late 2014, late 2018, and late 2022, I guess in 2014 was actually January 2015, you get a chart that looks like this. And if you zoom in to the current market cycle, this purple line, it's basically right in between the orange line, which is cycle 3, and the green line, which is cycle 4. So up until this point, we haven't really deviated from what we've historically done. It often seems like we have, but we haven't, right? I mean, this is what Bitcoin has historically done in prior cycles. Now, there is a distinction, though, between the last two cycles. In last cycle, Bitcoin continued to rally even at this point. It did not get a cool-off period of 3 to 4 months like it did in 2016. It just continued to rally, and then we had the pandemic drop. Basically, we got too overheated too early on in the cycle, and then we had a pretty big drop. Now, yes, it was caused by the pandemic. It's not like we can say, hey, that's going to happen again. It very well might not. There are risks involved with the market. We have an inverted yield curve. I think it is important to consider that that is a risk, considering that it has a pretty good track record. It's also impossible to know when that's going to get resolved, whether it gets resolved next month, 6 months from now, 12 months from now, or longer. We are entering the window, or we have entered the window when it normally gets resolved around this time, but we'll still have to wait and see just how much longer that's going to take. If the market continues to climb for the next couple of weeks, then it could signal a potential risk-off period as we get further out into the first quarter of 2024, as the market will likely need to at least go through some type of cool-off period. If it stays relatively flat, then it could just be a grind for several months without getting, a larger dip. So it kind of depends on potentially what happens over the next few months. With the potential spot ETF news, I would say there's still a risk that the greed sticks around for a little bit longer, and if Bitcoin does grind higher, then it would potentially set us off for a larger pullback later in the first quarter. There's another way to look at this as well. Okay, this is the obvious way to look at the market, and I think it's a relevant way to look at it, and I think it's foolish to look at this and say that this time is different, because so far it's not. It really is not. But there's another way that we can look at the chart that I feel like I have to continue to show it, mainly because if I don't show it and the market respects that view, then I might wish that I had spent a little bit more time on it. And it's the view that you're all familiar with, but it essentially says that Bitcoin goes up until we get to the point where rate cuts arrive. And when you think about rate cuts, we have to ask ourselves, why did Bitcoin find a local high? Why don't we call it a mid-cycle high? why did Bitcoin find a mid-cycle high in 2019? Now, you might say, well, Ben, that's because of the pandemic, and you should not think about the pandemic as something that we need to be concerned about this cycle, and I would agree with that. However, Bitcoin found this local high at which it did have a 50% correction before the pandemic was even a thing that I think was on any of our minds. Bitcoin topped out right here and then fell over 50% by the end of 2019. Okay, so this was a 50% drop. And you'll notice again that the local high came in just before rate cuts began. Now, I think that's fascinating. I wonder why that is. Well, I think you could argue, there's two arguments that I think come to mind for me. One of which is that there is such a thing as, the Fed, when they cut rates, they're likely doing so because they think the economy is weak. Do we really think they were cutting rates in 2019 because the economy was strong? Probably not. And so if they do cut rates in early 2024, it might be an admission by the Federal Reserve that the economy is kind of weak despite the headline numbers, right? There could be some softening up of the labor market, and perhaps they would like to get ahead of that. And so that might be why the mid-cycle top came in just before rate cuts began. Another potential reason is that when rates are going higher, you might argue that the counterparty risk goes up. A lot of zombie companies go under in the traditional financial sector, and perhaps Bitcoin is a hedge against that. And as you go back to lower interest rates, perhaps at least immediately that counterparty risk is no longer as big of a deal. Bitcoin puts in that mid-cycle top, cooling off until QE returns, and then going on a larger bull run. So I feel like I have to show this view because we have been following this view for a long time. We've also been following this view as well. And you could still have something where they both more or less play out, like where you look back at this in 2 years, you get some type of risk-off environment that leads the Fed to print something similar to what we saw last cycle, and then Bitcoin goes on, it continues to rally. So that is something that I think we have to think about. If you look at the total market cap of crypto, one of the things that I've mentioned is that I think 10 trillion is a possibility in the future. This is something that I've said, I think, since 2019. Okay, total market cap right now of crypto is 1.652 trillion. What's interesting is there are some things that line up here, and I don't know how much weight we should put into this because I often think that logarithmic regression models are better suited for cryptocurrency than just making a parallel channel. But for a moment, let's suppose that a parallel channel were the correct way to sort of plot out potential price action for the total market cap of the cryptocurrency asset class. If you take this high right here from late 2017, you'll actually notice that it connects the peak in May of 2021 and the peak in November of 2021 quite well. What's more interesting is if you pull this down to the December 2018 low, what you'll notice is that it sort of connects here to the pandemic sell-off, at least at the weekly close. There was a wick below it. You can see there was a long wick that went down, but in terms of that scare that led the Fed back to QE, this is what happened, right? We got a big scare in the market, QE returned, and then the asset class rallied back up. What's really interesting is when you connect the dots, when you connect this dot here to that dot, and you extend it down to the 2018 low, the 2019 mid-cycle high occurred right in the middle of that trend line. Right in the middle of that trend line. You can see right here that the middle of that trend line was at about 380 something billion, which is essentially where the total market cap of crypto topped out at that mid-cycle high, which again, coincidentally, happens to correspond to when interest rates started to go back down. So as much as I would like to not look at this view on the market because because I know it's not a popular view, until it deviates, I think it's relevant to follow. I also think that this one is relevant to follow, right? If the model's not broke, why do we try to fix it? But I also look at it like this. And I look at this and say, well, you know, last cycle we hit this high here. And then we hit the high again, and then we hit the high again. And then we hit this low, and then we hit the low again right here, at least on a weekly time frame with a wick below it, just as the last rate cut arrived. And then I look to the current cycle and say, huh, is it playing out in a similar manner where the potential, not guaranteed, but the potential mid-cycle top occurs at the midpoint, which is where it occurred last cycle as well, which, by the way, is also where interest rates started to go back down. The market is currently suspecting that the first rate cut might arrive by March. There's a chance it could happen in January. There's a chance it could happen in May. But currently, market expectations are that the first rate cut arrives in March. And so I do wonder if we are at all repeating what we saw last cycle with a potential cool-off period sometime after putting in this mid-cycle top, which again might correspond to approximately the first interest rate cut. So that is something that is on my mind. What's interesting is if you take the low from total market cap and just draw a trend line across the screen, you'll see that where we previously were finds the bottom of this channel by Q3 of this year, by the third quarter of this year. But you'll also notice that the trend line here would still be lower than the prior lows up until about that time. Now, remember, by this point, it gets you to around 750, 760 billion, which, by the way, is not that different from where this lower logarithmic regression trend line is. Remember, I said before, it's currently at around, it's currently between 7 to 800 billion, and it would take until about halfway through the year for this logarithmic regression trend line to be above the prior lows from late 2022, which is also kind of in agreement with this chart, even though it's a completely different model and looking at a slightly shorter time frame, because this model over here is fit to all data going back to 2010. This parallel channel is just looking at the last couple of cycles going back to late 2017. So I do wonder if there is a risk of the market playing out something like that, where you get some type of mid-cycle top around the time that rate cuts arrive, and then by the time that you get to the last rate cut and real QE coming back in, perhaps that's where we get another explosive move back up to the upside. One interesting thing about this chart is you can put some price labels on it, and you can see that that's around 700, 800 billion. This one's around 100 billion, maybe a little bit less, 90. And then you have 2.5 trillion and 3 trillion. So far, we've gone down to about 750 billion, okay? The low right now of this parallel channel at the bottom of the channel would correspond to 574 billion, but we're not there right now, right? And the chances that we were to go to that level in the next week are pretty small. And so the longer that it takes to ever go back to this channel, assuming that we ever do, the higher that it would eventually go. For instance, by April, that would actually be at 659 billion. By November, it would be at 841 billion, which again is above the prior lows from late 2022. So it all depends on when it happens, if it even does. If it even does. So just to throw a couple of numbers on the chart, what's interesting is if you then come back up to the top of the channel by 2025, by the way, let's just say April of 2025, which is when Bitcoin topped out last cycle, that actually puts you at $10 trillion, at approximately $10 trillion. Now, again, I don't know if we're going to make it to 10 trillion this cycle or not. I don't want to go into it deterministic. I think there's a chance that we could, but I also think that even if we do, there could be a period between now and then that leads the Fed to print. So far, we know that the Fed's main two mandates, right? We know that their main two mandates are price stability and maximum employment. For the last couple of years, the Fed has raised interest rates very quickly. Higher for longer has been their mantra in order to bring inflation back down. up until recently, the labor market has been relatively resilient. It hasn't really moved a whole lot. In fact, if you were to go take a look at the macro side of things, if you look at the unemployment rate, it is still relatively low. I mean, it's at 3.7%. So far, the labor market has not been an issue for the Federal Reserve. The labor market has been very tight. They've had really no choice but to raise rates to get back to price stability, which would then theoretically lead us to another phase of economic expansion. But I think there are some cracks starting to appear, and that's why in the last FOMC, Powell came out and said that we should expect, a few rate cuts next year. If you were to take a look at the number of job openings per unemployed worker, you can see that it's actually coming down pretty quickly. The reason it's not yet expressed in the unemployment rate is because for every unemployed worker, there's 1.34 job openings. So there's actually still more job openings than there currently are unemployed people. The problem, of course, is the trend, right? The problem is the trend. And back in April of 2023, this ratio was at 1.82. So it was essentially, almost 2 job openings per unemployed worker. That's dropped a lot. Now it's down to all the way down to 1.34. The issue, of course, is over the next 6 months, if the Fed does not cut aggressively, there's a good chance that this metric could continue to drop to the point where there's no longer enough job openings for every unemployed worker, which would sort of represent the idea that the Fed has achieved their goal of loosening up the labor market and getting rid of all that excess, right? You can see that the pre-pandemic trend, there was only about 1 job opening per unemployed worker, which was not bad. I mean, that was not a bad time for the labor market. It was about 1 job opening per unemployed worker. You can see that it dropped down a lot, but then they overshot it, right? And now we've been paying the consequences with higher inflation for the last couple of years. And so this continues to come down. And I think that the Fed sees these sorts of metrics, right? They see things like continued claims versus the unemployment rate. And they know that continued claims, as they go up, it can lead the unemployment rate, as we can see, right? This is something we've historically seen. As continued claims go up, normally the unemployment rate starts to go higher. Not in a linear fashion. It is a stochastic process, and all prior business cycles were a stochastic process where the unemployment rate would start to trend up and then maybe pull back for a couple of months and then continue higher. So there are risks in the labor market, and I do think the Fed has identified those risks, and that's why they've advertised 3 rate cuts in 2024. And I think that they do need to cut rates in 2024 in order to get fully ahead of all the lagged effects from all the interest rate hikes. Remember, we were near 0% a couple of years ago, and now the Fed funds rate is at 5.5%. So when we think about charts like this one over here, when we think about ROI after the bear market year low, we can see that it still lines up. And if we only looked at 2 cycles ago, it would look pretty okay. I mean, it hasn't really deviated from that cycle at all. But last cycle shows us there are always risks involved, right? If last cycle taught me anything, it's that we should not get ahead of ourselves. We should not assume that there can't be pullbacks, because there can be. And I know it seems like, I know with price action recently, there's been a lot of upward momentum. And it certainly seems like that kind of stuff can't happen to some people, but it can. And it doesn't mean that it will. And I know that, I get some flack for pointing out the downside risk quite a bit, but I don't want to ever stop pointing it out. I want people to at least understand what it is. I'm not saying don't be an investor in an asset class that you love. What I'm saying is that there's a risk involved. The way that I navigate the cryptoverse and the way that I've navigated it for the last couple of years is to keep my portfolio mostly just Bitcoin. And I've missed out on some pretty epic gains in the altcoin market because I chose to do that. I also argue that I've minimized some of my losses, especially in 2022 and for a lot of altcoins in 2023, just by following the Bitcoin dominance trend. But that is something that I think is worthwhile to consider, is the idea that, we can look at it like this, ROI from this low. We can also look at it like this, which is, do we get a mid-cycle top around the time that interest rates begin to be cut? And if that does happen, does it tag this trend line, sort of the middle part of the trend line, just like it did last cycle? Last cycle, that mid-cycle top came in the summer of the pre-halving year. This cycle, we've already gone a lot higher than where we were in the summer of the pre-halving year. But again, we also haven't had rate cuts yet, which we were starting to get by the midpoint of the pre-halving year in 2019. So this is an important way, I think, to look at the cryptoverse. And it kind of gives you two ways of viewing where we potentially are within the market cycle. If you think we're more based on monetary policy, if you think the cryptoverse more depends on monetary policy, then I imagine this would be more interesting to you. If you think that it exists outside of monetary policy and that it's just details that we don't need to worry about, then you're probably more comfortable just looking at charts like this and saying, yeah, you know, there can be moves to the downside just like there were last cycle, but the general direction has still trended upwards from this point in the cycle, even though there was a pretty big sell-off in the last cycle. So a lot of different ways to view the current market cycle, if you want to even call it a market cycle. A lot of people think there aren't even such things as a market cycle, which I can respect that view too. I mean, you know, while I think a lot of us sort of look at the cycles and say, well, this peak occurred in late 2013, this was late 2017, most metrics really do say that this was the top, and that this, while technically a higher price, wasn't really supported by anything else. But at the end of the day, price action is king. So, I mean, to hell with the indicators. If price goes higher, right? I mean, who cares if the indicator didn't say that it was going to? Another way to look at the market that could give more credence to the idea of the process of finding some type of mid-cycle top could be the social risk, right? So if you were to go look at the social risk, what you'll see is that in May of 2019, it actually went up to about 0.3 risk and then had a pretty big drop to below 0.2 risk, which is actually what just happened, right? It just went to above 0.3 risk and then it just dropped down to less than 0.2 risk. And that actually marked the high for social risk for a little while. You can see that it did go back up after this high here did not even correspond to the high in Bitcoin price. Bitcoin's price actually went a little bit higher and the social risk put in a lower high right around the time that rate cuts began. And so if Bitcoin were to get another move to the upside going into a potential spot ETF, then I would say let's keep an eye on this trend line right here. Let's keep an eye on that trend line. And what's fascinating about this trend line, this blue line that goes to the middle of the page, is that it's essentially right at 2 trillion, right at 2 trillion. I mean, you can see it's like right here by February, the first week of February, it would correspond to approximately $2 trillion, which is also interesting. The reason why $2 trillion is interesting is if you look at where it topped out last cycle, it topped out just below that dead cat bounce that occurred in the first half of the bear market year. This area right here, that 2 trillion, would correspond to just below this dead cat bounce from that same prior cycle. So just something to think about. And again, I don't know if Bitcoin's going to push higher into the spot ETF. If the spot ETF is rejected, then I imagine that would be a very big surprise to the market. And you know, the market would likely sell off in the short term if news came out that the spot ETF were rejected. If the spot ETF were accepted, then perhaps you go into this process of putting in a mid-cycle top. One other aspect to Bitcoin that I think is important is Ethereum. I think Ethereum is fascinating to understand where Bitcoin is within its market cycle. And the reason why I say that is if you think about the market, if you think about like the cryptoverse in terms of liquidity, the place in the cryptoverse that has a lot of liquidity besides Bitcoin is Ethereum. And what's fascinating to me is that this is playing out in an almost identical manner, not in terms about the time it took to get to this level, but take a look at it like this. Let's look at this for 1 minute. And I think Ethereum can give us some insight into potentially where we are. If you look at this low right here and you go across the screen, you'll see that I'm going to shift this up just to sort of connect to these points right here. And what you'll see is we put in a low, and then the Ethereum Bitcoin valuation sort of flirted with that low for a long time before it eventually broke down. It eventually broke down. And what's fascinating to me is that when it broke down from this wick, it broke down after 83 weeks. So the initial wick took 83 weeks to durably break below. Now, let's do the same process this cycle. You can see that there's this initial wick down here, and then the Ethereum Bitcoin valuation keeps, trying to go below it, but it hasn't done so far. And seasonality, now that we're in the early part of the year, isn't as bad for Ethereum as it is in the last part of the pre-halving year. Be that as it may, if you take a time, like a range here from this low here, and you were to go out, say, 83 weeks, it would put you the week of January 15th. The week of January 15th. And so I really do wonder, and again, I think we're going to know very, very soon if this is the correct way to view the market or if it's not. I think we should know very, very soon. We've been following this forever. I would feel remiss if I didn't follow through with it, especially considering where the Ethereum Bitcoin valuation is right now. If there is some type of Bitcoin move over the next 2 weeks as we get into the spot ETF news finally breaking, and if Bitcoin were to break up and go to sort of the trend line here, which might mark a mid-cycle top, and if it breaks Ether Bitcoin down off of this trend line, which it also broke over here, what you'll be interested to know is that when the Ethereum Bitcoin valuation finally broke last cycle, it also corresponded to when interest rates started to come back down. So you'll see right here that the breakdown of Ether Bitcoin occurred right before rate cuts arrived. And we're likely we're on the verge of rate cuts again, probably within the next 2 to 4 months. We're probably going to get rate cuts. So I do wonder. I'm not discounting a potential. I'm certainly not discounting Ethereum Bitcoin from bouncing. I mean, even back over here, it got several bounces before it finally broke down. And so I'm aware that a bounce could happen by the Ethereum Bitcoin valuation, and if it did, I would still keep my eyes on the bull market support band, which is currently at around 0.056 to 0.057, right? But it does seem like monetary policy is at least relevant to follow, considering that Ether Bitcoin broke down just before rate cuts arrived, considering that total market cap found a local high before cooling off for a period just before rate cuts arrived, and considering that when you look at last cycle, there was an accelerated move going into the next 2 weeks. We're currently on day 417 of the cycle. Last cycle, Bitcoin found a local high about 10 days from now before going risk off for a few weeks. Again, it was a higher low, right? It was a higher low, but that is something that at least did happen. So I will continue to follow this model here, basically the model that looks at this larger channel, potential mid-cycle top at around the same time that interest rates begin to be cut. We'll take a look at the Ethereum Bitcoin valuation as it continues to be really between a rock and a hard place. The bull market support band is squeezing it down, but it also is fighting to stay above this trend line here. Perhaps the spot ETF or the halving will be enough to knock Ether Bitcoin down if it's going to. And if it doesn't, then we're deviating from the prior cycle. And then also to think about the social risk. Is it, are we going into a period like this where we, while some momentum has come back in terms of sentiment, it still doesn't go all the way back up to the higher risk bands, right? Because you have to have, to get back up there, it takes a lot. Right. You think about all the price action that we've seen, and there's a lot of people that haven't returned. Go look at YouTube views. Doesn't really look that different from what we've seen. And I mean, in fact, if you were to look at a 30-day moving average, the number of YouTube views for these YouTube channels, including my own, it still is a lower high, right? There still haven't been a lot of people that have come back, even though Bitcoin has exploded this much to the upside. How do we get people to come back? How do you get people to come back to the Cryptoverse if higher prices haven't done it? Well, one thing would be if Bitcoin were to break to a new all-time high, that would probably bring a lot of people back. But the counterpoint also is that the way you bring people back is you go back to looser monetary policy where people feel like they can actually start speculating on higher risk investments again. I know there's a lot of people watching this channel right now that are like, well, Wes, what do you think we've been doing for the last 2 years, right? But you also have to remember that right now, these channels right here are averaging, 600,000 to 700,000 views a day. But at the peak of the bull market, these channels were averaging over 2 million views a day. So while you might be looking at this and thinking like, well, we've been speculating dubiously for the last 2 years, there are a lot of people that have left. I mean, you can see it, right? You can see YouTube views. You can see just how far down they've gone. And I do think eventually people will return. I just wonder if in order for them to return, do we need to get back to quantitative easing? I would think so. I think QE would likely need to come back. And I think that the way QE comes back is you get some obvious softening up of the labor market that gives the Federal Reserve an excuse to start printing. And if they start printing aggressively, that's when risk assets go back up, and perhaps that's when we'll finally reach our $10 trillion. But even if we do go to 10 trillion, it's still several years away. And as I said before, well, likely several years away. I guess it could happen anytime. I mean, these models are of course, all models are wrong. Some are useful, right? But I'm still thinking that there's going to be a period at some point, likely this year, where the yield curve uninverts and we have to deal with the fallout of that, right? The uninversion of the yield curve, right? If you think about treasury yield spreads, we're gonna have to deal with the fallout of the uninversion of the yield curve at some point this year, which would imply that the Fed is cutting rates. And normally when the Fed starts to cut rates, it's because something is happening in the economy that is forcing them to do so. They're seeing something that makes them want to cut. And they've already advertised that. We're likely going to get rate cuts here in the next few months. And then we'll see how the market responds. And if the market responds negatively, then that would likely bring back quantitative easing. And if quantitative easing comes back, then that would likely bring back these speculators back to the Cryptoverse, because monetary policy isn't as tight as it has been for the last, year and a half or 2 years or so. But this whole exercise that we, these beauty of mathematics videos, the whole point is to just give you that 1,000-foot view, right? To say, look, the market, the asset class has been undervalued since June of 2022, and despite that, it could become more undervalued at some point. I mean, like we've basically just been in this range for a long time, and maybe we'll continue to be in it. In this cycle over here, we dropped below this in January 2015. We didn't durably get back above it until 2.5 years later. If this cycle were to emulate that, 2.5 years later for this cycle would correspond to basically the beginning of 2025 to durably get back above it, if it were to play out like the 2016 cycle, which is still another year away. So we'll see if that happens. I do hope you guys enjoy the content. I do hope the Beauty of Mathematics series has been useful to you in navigating the Cryptoverse, trying to tune out the noise, and just showing that the asset class does go up as a function of time. There are risks that we have to consider, and failure to consider those risks could be detrimental. If you consider the risk and you invest anyways and the market goes up, hey, you took on the risk and it paid off. Congratulations. If you don't take on the risk and the market goes up, then you didn't take on the risk, right? So we'll see over the next year if we do get some type of larger pullback like we did in the last couple of cycles or not. And we'll see if that mid-cycle top comes into play or if we just blast through it. I do think it's important to have invalidation criteria. I mean, I don't want to just put out a model like this and then just not talk about it in the future. But I would say that if the total market cap blasts past 2 trillion, then it's deviating from what happened over here. Okay, because over here it went up to the midpoint of the channel and then it got a larger pullback. And so we'll see if that happens again or not. And if it does happen, I mean, if Bitcoin were to rally up and lift the asset class higher again, then I would just look towards that $2 trillion milestone. And by the way, $2 trillion from this level, it's still, it's about 20% higher than we currently are. And what's interesting is if you zoom in, we actually already tagged it back in August 2022. I mean, you can see we came back down and we bounced right up to that trend line, which is where we are not too far away from right now. So I will continue to look at the market through the lens of monetary policy. I will continue to look at the market through the lens of the Ethereum Bitcoin valuation and through the social metrics and through the ROI from the cycle lows, or at least the bear market low, the low from the bear market year. We'll look at it throughout all these different ways. And hopefully it can help some of you guys navigate the Cryptoverse. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Links in the description below. I still do think that the market cap of crypto will eventually go to 10 trillion, probably within the next few years, plus or minus a few trillion. As we go to sleep at night, we cannot help but wonder, what's a few $1 trillion among friends?